Everybody, welcome to episode 17. My name is Chris Whitehurst. Each episode I try to explore a term or a concept you may encounter in a real estate transaction and explain those in a way in which I hope is easily understood. Today we're going to be talking about loan to value and how that creates equity in your home. Let's put our investor hat on. Your loan to value is how much money you owe versus the value of your home. Let's take an example. We've got a $250,000 home and you have 10% down. That means you're borrowing $225,000. Your loan to value, sometimes you'll see an abbreviation LTV, in this scenario is 90%. As the home appreciates, meaning it goes up in value over time, and you make payments, both normal and additional payments, your LTV, loan to value, goes down and your equity goes up. Equity is the value of the home minus your loan. In our above scenario, you started with $25,000 in equity. Over time, with natural appreciation and normal payments, your equity is going to go up. This is important to think about when you're buying your home. You'll need to work up that equity so you have enough headroom to sell when you're ready to move up to your next forever home. If you like these videos, there's more of them on YouTube and Facebook. If you like what you see, be sure to follow, like, and share. I got more great content coming soon. I'm Chris Whitehurst. Welcome home.